If you own rental property and you're not taking these 9 tax deductions, you could be overpaying the IRS by thousands of dollars every single year. And here's the scary part. Most landlords miss at least 3 of them. Today, I'm breaking down the top 9 rental property tax deductions, how they actually work, and where landlords mess this up, especially here in California. And quick disclaimer, this video is for education purposes only, and always confirm this with your CPA. So let's get into it. Here's the big 3 that every landlord should know about. The first one being your mortgage interest. If you have a loan on the property, your interest is tax deductible, but not your principal, just the interest. So for many landlords, this is one of the biggest deductions you can take, especially in the early years. The second one is your property taxes. Yes, your property taxes are deductible as a rental expense. The third one is depreciation. This is the big one. The IRS currently allows you to depreciate the structure over 27.5 years. This is a non-cash deduction, meaning you deduct it even though you didn't spend money that year. This alone can sometimes wipe out taxable income on paper. But remember that depreciation recapture can happen when you sell the property. Now, a lot of landlords forget about their operational deductions. So let's talk about repairs versus improvements. Repairs are deductible immediately. Let's say you had a leaking faucet, you send the plumber over to repair the faucet. That would be a repair, and that would be deductible immediately. Improvements, though, those get depreciated. So if you remodel the entire kitchen, that goes into the improvement category and then gets depreciated. Some landlords forget about insurance. Your insurance is tax deductible as an operational expense, as well as any umbrella policies you might have. Property management and leasing fees are tax deductible. So if you hire a full-blown property manager or you hire a leasing agent, you can deduct that as an operational expense. But if you self-manage, you don't pay yourself. Other operational deductions are also travel and mileage expense. So driving to and from the property to maybe meet vendors, meet tenants, do showings, Home Depot runs. Just make sure that you track your mileage. You can also potentially take the home office deduction. If you have a dedicated home office space that is used exclusively for rental management, that might qualify. Again, always check with your CPA. And the other operational expense are your professional fees. So CPA fees, legal fees, bookkeeping fees, different things like that, all deductible. Now here's the real issue. Most landlords don't lose money because of taxes. They lose money because they don't have a system and they don't track. They don't keep mileage logs. They don't accurately track their expenses. They have no documentation for repairs. So, which means when tax time comes, you're either scrambling to try to get all of the information put together, or you miss the deductions entirely. And that's exactly why I built Lease Like a Boss, because it teaches landlords how to run their rental properties exactly like a business. Now, here are some advanced tax strategies that every landlord needs to know about. These aren't beginner concepts, but you as a landlord, if you plan to scale, you need to know what these are. And if your CPA or your accountant immediately says you don't qualify without explaining why, it is time to find a new CPA that specializes in working with real estate investors. Making this one mistake in not using a tax professional that is savvy in the real estate space could make the difference between you having a 5-figure tax bill or getting a 5-figure tax refund. The first advanced strategy is cost segregation study. And this is a tax strategy that accelerates your depreciation. So instead of depreciating the property over the standard 27.5 years, a cost segregation study breaks down the property into different components. Appliances, flooring, cabinets, electrical, plumbing, landscaping. Some of these items can be depreciated over 5, 7, or even 15 years instead of the 27.5 years. What that means is that you can take larger tax deductions sooner. You'd have less taxable income in the early years and more cash flow now. This strategy is especially powerful if you're a high income earner, you own short-term rentals, or you just newly acquired a rental. It's not automatic. It requires a cost segregation study to be done. And if your CPA has no knowledge of this, that is a red flag, and it's time for you to change CPAs. The next advanced strategy is bonus depreciation. The simple definition of bonus depreciation is bonus depreciation allows you to take a large portion of depreciation up front instead of spreading it out over decades. When paired with cost segregation, this can create significant paper losses in year 1. For example, you buy a rental, do a cost segregation study, Instead of the small yearly deductions, you may deduct a large portion. Now, it's important to know that bonus percentages phase down over time, and laws, of course, change, so you always want to consult with a real estate savvy CPA. But again, if you own rentals and your CPA has never even explained what this is, you're not getting strategic guidance. Now, the next one to cover is depreciation recapture. And this part a lot of people ignore. Depreciation recapture is what happens when you actually sell that property. So what the IRS says is if you took depreciation deductions, we want some of that back. So when you sell, you might not only pay capital gains, but you'll also pay recapture tax on the depreciation that you claimed. So this is why strategy matters. Your strategic options might include doing a 1031 exchange, being able to offset the recapture tax with other losses, hold the property long term, or discuss other type of estate planning strategies. Depreciation is a very powerful tool, but you need to understand that if you sell that property, what the implications are if you exit out of that investment. This last one is where you can see some really significant tax benefits as a landlord. And a lot of savvy real estate tax professionals talk about this a lot, and it's rep status, real estate professional status. And especially if you're a high income earner, this changes the game for you. So normally rental losses are considered passive, and passive losses can only offset passive income. But if you qualify for real estate professional status, your rental losses may offset your active income, meaning your W-2 income and your business income. The requirements for this generally include more than 750 hours per year in real estate activity, or more time in real estate than any other trade or business. It's not automatic and it must be documented properly. Where you see a lot of landlords get rep status while they still have a W-2 job is typically when they have a short-term rental that they manage themselves. It is one of the most misunderstood strategies in real estate investing, so making sure that you're working with a savvy tax professional that can help you with this is key in being able to scale and get the most amount of benefit from your rental property possible. So the real talk about CPAs or your tax professionals, if your CPA or your tax professional says you don't qualify, that's risky, we don't do that, oh, I've never heard of that, or you send them a YouTube video, for example, like I've done with previous tax professional we were working with, and they had no clue what I was even talking about and said we couldn't do that. If they can't explain or answer any of your questions, you probably outgrew them and it's time to get someone else to help you. You might just have a CPA who is there to just file the taxes, not help you with strategy. So my piece of advice is you want a CPA and tax professional that is going to help you with strategy, that specializes in rental property investing. Someone who understands cost segregation, bonus depreciation, real estate professional status, someone who can really help you maximize the benefit of owning rental property. Now, if you own a rental or you're planning to convert one of your properties into a rental, you definitely need to understand the tax side before you scale. And if you want a system that is clean, predictable, and organized and teaches you how to run your rental property like a business, you can grab my free landlord training at the link in the description below, and it will get you moving on the right path. And as always, happy landlording!